in case this question crossed your mind, 25 stocks in a portfolio globally, how do you whittle down to the best companies in the world? It's through this process, and I should note that this process has been in place since 1989. So if we start at the very bottom of the mountain, there's about 3,000 stocks in the universe around the world with a minimum market capitalization of about $10 billion. So that's around the minimum size that we're looking at, but that's not a hard and fast rule. When we put these through what we call our guardrails, which are in the lower left of the slide, and again, these guardrails have been in place since 1989, and these guardrails are named as such because they really do keep us safe. So we put them through these 5 guardrails. We got return on equity of 20% or greater. Capitalism is kind of like nature. It's a brutal place. And if you don't have some competitive advantage protecting yourself, your business, new entrants are going to come in and take those profits from you. So a 20% or greater return on equity, it tends to be a signal that there's probably something special going on with this business. And that's just one of the 5. Another is exceptionally strong balance sheets. So people often think, is a lot of cash really a competitive advantage for these businesses? And the answer is yes, and it is when you need it the most. And as Damon talked through, during the first quarter of last year, a lot of our outperformance, we like to think, came from this balance sheet strength, where a lot of companies were really facing potential liquidity issues and weren't even sure if they were going to survive when the pandemic unfolded. It was very easy to sleep at night as managers of this portfolio and for our clients, knowing that the majority of our companies have more cash than debt. So return on equity of 20% or greater, stable balance sheets, stable or growing profit margins, also a signal that there's probably something special happening with the business, tons of free cash flow, and last but not least, real organic revenue growth. This goes back to risk mitigation. We've never been involved in a company that derives 100% of its growth from an acquisition strategy, commonly referred to as a roll-up strategy. When we put these through our 5 guardrails, the universe of about 3,000 vanishes down to about 350 businesses. And from here, almost as important as what we have owned is what we have not owned. And if you think back to our goal of very strong, consistent, and persistent earnings growth, it's hard to achieve that if you have very cyclical businesses in the portfolio. So to that end, we've historically not owned materials. Utilities businesses don't grow fast enough for us. Telecom businesses, they tend to be very capital intensive and thus very cyclical. Energy businesses, we've historically not owned. REITs or banks. Banks can be very competitively advantaged, but they typically do not pass our debt limits. And even when they do, it's so hard to know what's on their balance sheets that it's typically not a business that we would own. So then we get rid of those. Again, an 11-person team. Our entire investable universe is roughly 150 companies large. About half of those are domiciled in the United States, and the other half outside of the United States. This is an extremely iterative, deep dive process once we get to this point. If it takes us 2 years to research a business in a very collaborative fashion before we get comfortable with the competitive advantages, we're happy to take those 2 years. We're never in a rush. Our average holding period for the businesses that we do own is about 5 years. So this is a positive knock-on effect that enables us to really take our time and do the research that we believe is required to get to know the competitive advantages and not only their existence, but their sustainability. More often than not, we do meet with management teams, although it's not required. And when we meet with management, we're not asking about the next quarter. We're asking about what they think their competitive advantages are and how they're allocating their resources, their labor, and their capital to strengthen those competitive advantages. And then the final step at the top of the mountain is Damon and I will pick what we assess to be roughly the best 25 businesses in the world, and out of that group of our coverage universe of about 150. There's ongoing research, not only for the businesses that we do choose to own, but also for the businesses within the coverage universe that we don't own.